Are we witnessing a financial revolution post-election?
We've gathered key insights from experts like Jason Shapiro and Stephanie Pomboy to keep you informed.
And the best part? You'll get all the essential points in just minutes.
Absolutely. Find out why Bitcoin could hit $112,000 as experts weigh in on market trends.
Welcome to Financial Insights in Minutes, where we bring you the latest in financial news.
Stay tuned as we cover predictions on market corrections and the global economy's outlook.
But first, let's delve into Jason Shapiro's insights on Trump's election impact with Crowded Market Report. Today's focus is on the remarkable outcomes of the recent election. Jason Shapiro is sharing his insights on what this means for our economy.
Absolutely, it's impressive to see the market's reaction. Trump's victory seems to be setting a bullish tone.
What's the core thesis here regarding Trump's election impact?
Jason believes the positive market movement is signaling growth potential rather than inflationary concerns, which is quite a bold assertion.
The market hasn't just reacted, it's soared to new all-time highs. The S&P and Dow are leading the charge.
Indeed, this rise indicates a strong bullish sentiment among investors in light of Trump's plans.
Shapiro brings up an interesting point about bonds. How are they weighing in on this growth versus inflation debate?
Yes, the decline in bond prices could suggest growth optimism rather than inflation fears, flipping the narrative.
So, what policies is Trump proposing that could bolster this growth?
He aims to reduce regulations and lower energy costs. Both are key to fostering a robust economic environment.
What does this mean for investors' outlook going forward?
The sentiment is decidedly upbeat. If this growth potential is realized, we'll likely see further market rallies.
Shapiro predicts continuous market rallies. What's backing this optimistic forecast?
The unfolding policies post-election could provide the fuel needed for further growth, creating a favorable environment for investors.
And how might inflation play into this scenario if energy prices drop?
Should Trump's plans materialize, inflationary pressures could ease, allowing for more stable growth.
Wrapping it all up, how should investors position themselves considering these insights?
They should keep an eye on growth potential while being prepared for any fluctuations. There are opportunities to seize.
In the wake of Trump's election win, let's dive deep into how the markets are responding. What a tumultuous 24 hours it's been.
Absolutely, David. Stocks are skyrocketing, and we just witnessed Bitcoin reaching new all-time highs.
So, Chris, what's your take on the thesis behind this rally?
While the initial reaction is certainly bullish, this doesn't negate the broader economic cycle we've been seeing.
Interesting. What are the key indicators you're watching?
Economic fundamentals, investor sentiment, and potential for higher interest rates are critical factors to consider.
What does this immediate market reaction tell us?
It shows confidence in Trump's pro-business approach, but it's essential to recognize the short-lived nature of news-driven rallies.
What are the underlying warnings you're seeing?
Despite the rally, issues like rising interest rates and declining real estate health could lead to a long-term downturn.
Bitcoin seems to be bucking the trend. What's your outlook?
I see Bitcoin reaching about $112,000 based on current momentum. It's intriguing.
Chris, how should investors approach this rally?
It's wise to secure profits cautiously and maintain a risk management strategy. Markets can turn quickly.
Looking ahead, what should viewers anticipate?
The potential for a financial reset and subsequent market corrections looms large. It's a cautious path forward.
What's the latest prediction for the SP 500?
I forecast it could rise to around 6,158 based on market conditions and momentum.
And what about Bitcoin's trajectory moving forward?
I'm optimistic about Bitcoin reaching around $112,000 given its current momentum.
To wrap things up, what should investors keep in mind?
Stay cautious but opportunistic. Be ready for potential downturns while also seeking strategic gains.
As we head into the future, what's the key takeaway?
Recognizing the emotional triggers behind market movements will prove essential as strategies unfold.
A crucial shift is happening in the monetary world. Evidence suggests a downturn might be lurking.
Yes, interest rate swaps are plunging, sending potentially alarming signals about the broader economic landscape.
What's at the core of this narrative about interest rate swaps?
The ongoing decline suggests that market participants foresee a significant drop in interest rates, possibly leading to a recession.
Interesting. What has shaped these expectations?
Key indicators have consistently worsened, highlighting systemic challenges that likely culminate in lower rates.
What do we know about the current swap market trends?
Swap spreads are hitting record lows, a clear indicator that the market anticipates lower interest rates.
How do these trends relate to the broader economy?
The economic indicators hint at a recession as labor market data shows consistent weakness, aligning with what swaps predict.
How is the Federal Reserve's stance impacting all of this?
The Fed's changing rhetoric signals to the market that cuts are anticipated, further supporting the negative swap spreads.
What are the future predictions based on these swap trends?
The ongoing movement suggests rates could drop significantly and stay low, indicating enduring economic issues.
What does the forecast tell us about interest rates?
It's anticipated that rates will plunge and may lead to recession according to current swap trends.
So what's the take-home message from this analysis?
Investors should brace for a potential downturn as market indicators strongly suggest lower interest rates are on the horizon.
With such strong signals, what should viewers do next?
Staying informed and cautious is crucial as we navigate this evolving landscape.
Today, we're diving deep into the market dynamics following Trump's election win. With expert analysis from Stephanie Pomboy, it's all about understanding the impending economic shifts.
Jeremy, the thrill of the election's outcome has sent ripples through financial markets, and it's vital to unpack what's next.
So, what's the essence of Stephanie's analysis post-election?
Her thesis centers around a dual narrative. Optimism from Trump's policies may be overshadowed by underlying financial vulnerabilities in the corporate sector.
How did the market respond to Trump's victory?
The initial reaction was positive, with major indices spiking, but underlying factors indicate it may not be sustainable.
And what's the potential fallout from rising interest rates?
Higher rates can squeeze corporate profits and trigger a financial downturn, especially for over-leveraged companies.
What's happening with gold in this environment?
Gold's price could be pressured by dollar strength, but Pomboy believes it will eventually regain its footing in a bullish market.
What does it take for the economy to stabilize amid this chaos?
Sustained economic growth combined with prudent fiscal policies is vital to navigate the looming financial challenges.
What are analysts predicting for the S&P 500 going forward?
Expect fluctuations as rising interest rates could disrupt current trends.
And what can we expect for gold prices?
Despite short-term fluctuations, gold is likely to lose ground as confidence in the dollar wavers.
So, what should viewers take away from Stephanie's insights?
Essentially, while optimism is warranted, vigilance against rising financial threats is crucial for investors moving forward.
Today's focus is on exploring how the election results have shifted market dynamics. Let's dive deep into what this means for traders.
Absolutely. Despite a major gap up in the S&P 500, we can't ignore the Fed meeting coming up soon.
What's the central idea that arises from this market shift?
Matt suggests that while there's substantial bullish activity, the reaction of the Fed and bond market could significantly influence future movements.
That really pulls the viewer into understanding the balance of optimism and caution in trading.
Exactly. It's crucial to consider both sides for a rounded analysis.
So, how did the market respond to the election results?
The S&P surged to new records, which shows trader enthusiasm at a heightened level.
What key levels should traders keep an eye on?
Support levels at previous highs will be critical, especially if the market pulls back slightly.
What do we expect from the Fed meeting?
A lot rides on how Jerome Powell addresses the current market volatility, especially in bonds.
In this bullish environment, what's the best strategy?
Risk management is key. Traders must be ready for any market corrections while capitalizing on upward trends.
What does Matt predict for the S&P 500?
He anticipates continued uptrend if recent support levels can withstand pressure.
How will the Fed's decisions affect the market?
The tone of their statements will be pivotal. If they seem hawkish, we could see increased volatility.
To wrap this up, what should viewers keep in mind?
An infectious optimism exists, but staying aware of the risks is crucial moving forward.
Sounds like a balanced approach as we prepare for the next market moves.
Absolutely. A blend of caution and readiness for opportunity is essential.
Today, we're grappling with some heavy predictions from David Stockman on potential market corrections. Buckle up, folks.
That's right, Adam. Stockman is clear. We may be on the brink of a significant downturn.
So, what's the crux of Stockman's thesis today?
He firmly believes the math just isn't adding up for the current fiscal policies, which could lead to major market corrections.
And he points to specific indicators, right?
Absolutely, he correlates the structural deficits with future market instability.
Let's dive into the structural issues here. What are the main points?
Stockman emphasizes that both major parties are perpetuating unsustainable fiscal policies.
How about inflation? Why does it concern Stockman?
He sees the current inflation as both persistent and damaging, compounding fiscal issues.
And that leads us to potential outcomes, right?
Yes, Stockman predicts major corrections as market realities hit.
How severe does he think this market correction will be?
He's projecting anywhere from 30% to 50%, a dramatic shift.
What about the Fed's role? How does he see it evolving?
Stockman believes the Fed will struggle to respond effectively to rising yields.
What should viewers take away from this conversation?
It's vital to adopt a cautious approach and reassess investment strategies.
Investing wisely now could protect against future volatility.
Absolutely. Adjusting to the shifting market landscape is crucial.
What an insightful discussion we had today. Experts like David Stockman predicted a steep market drop due to inflationary pressures.
Indeed. Yet Matt and Jason seem quite optimistic about the market's rally, suggesting that investors are feeling a strong risk-on sentiment.
And Stephanie Pomboy's warning about rising bond yields really adds another layer of complexity to this conversation.
Absolutely. And Chris Vermeulen's perspective of a short-term bullish period makes it clear we have to stay vigilant.
Viewers, the landscape is shifting, and there are a lot of insights to digest. Always remember to weigh these opinions carefully.
If you found value in today's analysis, like this video and subscribe to our channel. That way, you won't miss any future financial insights.
Thanks for joining us today. Be sure to check out our other videos for more valuable content.